Portfolio Builder members, welcome to today's webinar. We're starting to get quite a large crowd, so I probably won't unmute everybody like we have been enjoying with the smaller crowds, but just throw out a few names. Welcome David, Gilbert, Henry, Jeff. Let's see, we got Kayleen, Mark, Neil, Reggie, and Steve, and more people are joining. Henry, John just joined in. This is starting to get quite a crowd, so welcome everybody. Thanks for joining the webinar. And boy, oh boy, is the S&P 500 on fire. In fact, this is one of the times where we wish we weren't playing it so safe. We missed out on a ton of profit over the weekend and only got to keep our measly 86 bucks per contract we wrote relative to potentially having brought in somewhere around the mark of $400. So let's take a look at what's going on in our portfolio, and then we'll open it up to Q&A, and then we'll probably do a demo where I'll take a few folks from the audience, and we'll start to build out your platform and your portfolio with some feedback. So today our portfolio jumped in about $1,000 of profit from last Friday, and we were playing it safe. We had a covered call, which we had to cover this morning for a 150% loss. Now that's misleading because we didn't lose any money. Anytime the stock market goes up in our program, we do well, and so does the person who purchased the covered call from us. And so the amount we gained in our underlying asset was greater than that of which we lost on the covered call. Now, in the situation where the market goes flat or slightly down, that's where our strategy truly outperforms the rest. Let me see, we got some questions popping in. Hey, John, yeah, welcome. I have everyone muted right now just because we have such a huge audience. I don't want a ton of audio flowing through, but I will open it up in a bit after a quick demo here. So we were enjoying having the whole crowd speak for the last few weeks, but we're getting a bigger and bigger audience now. So we will definitely open it up in a little bit. So let's just review the last few trades and the overall general program by going through today's trade alert. So the beginning of each trade alert goes to show you the overall goal of our program. And essentially, if we have 100 shares of the SPY ETF, we have the right to write one covered call every Monday, Wednesday, and Friday. These expire in about 48 hours, and we can do it 3 times a week, 52 weeks a year. You add that up, that's $15,600 a year of income just from writing a very, very easy 2-minute covered call 3 times a week. Now, I want to point out that our audience are typically 50 to 80 years old and looking for safety over growth. So our product does not try to capture the full $100 every single trade. And you'll see that most times we'll go for even less than that, anywhere from $50 to $100 on the covered call with some downside protection. And we'll get into what the biggest risk is with this system in a little bit. But essentially, we are purchasing lots of 100 shares of the SPY ETF and then writing a covered call 3 times a week. And so we launched this portfolio along with the other ones I'll demonstrate shortly right here. So you can see what normally might have looked like a safe time to buy the dip was actually a day before a horrendous crash. And because our strategy follows the momentum, looks where the option trading volume is flowing, we were able to sell protected covered calls during this period and have very little drawdown. Now the catch is that on the upside, we didn't capture this full profit that buy and hold investors had during that period either. And so that's the whole point. We want to take the sting out of the downside and still enjoy a lot of the upside. And so that's what happens when we write the covered call. We buy the best security in the world, which is the S&P 500, and that is because it diversifies your portfolio into 500 corporations, removes a lot of risk from any single company having problems that could cause problems in your retirement. And it's also the most highly traded security in the world with the most advanced options market. It's the only security where you can do a covered call every Monday, Wednesday, Friday. So being a small fish in the big pond, you can do this strategy, you can take advantage of it, you can own a very stable product and generate a very high return and take the guesswork out of trying to be a stock picker or do advanced options trading or be some sort of crazy day trader. If you want to have a funny money account, go for it. This is really your bread and butter program. Now, for those of you who don't have the full $28,000 that it costs to purchase 100 shares of the SPY, we have what we've labeled the poor man's income strategy. And there's nothing poor about it. It just costs less to get started. This trades the TBT inverse 20-year Treasury ETF. And so the main thesis behind this underlying asset is that the government is creating larger and larger deficits, and over time, that will create a higher and higher cost of borrowing money. And so if this prediction is correct, the TBT has a lot of upside potential and makes it a very good product to write a covered call against. Now this program did see a big jump overnight. We were seeing a divergence in the bond market from the US, from global equities, which was confusing a lot of folks. And for many people, they're having a hard time watching the TBT go down the last few days. Of course, we've told everyone to hang on tight, that this is not a long-term trend. So we did have a big jump in the TBT, and that did push our profits very close to where the S&P 500 strategy is. Now, this one has more volatility because it's at the whim of the Federal Reserve changing rates, and only trades once a week. So Friday, we roll over this position. You don't have to wait till Friday to start following this program. If you want to start right away, the first step is get 100 shares of the underlying asset, TBT. And this is a covered call that's good through this Friday. That's just above the current trading price and is our current recommendation. Now, jumping over to our spreadsheet again, we can see the current trade alert today is once again slightly defensive. It's $1 below the trading price for a credit of $1.71 and expires this Wednesday. So the plan will be next Wednesday, we will buy back this position and write a new one expiring next Friday. Now, if I switch to our Tuesday class, those of you who are, Steve says, just a short-term pullback. Are you asking if that's what I'm predicting, or? Okay, so moving to our Tuesday class, for those of you who have a little bit more capital to put to work, this is a great program that has a larger return. It's not quite double, but it's almost double the return of the S&P 500 company strategy. And this takes the same assets owned by the S&P 500 SPY ETF. It looks at where the largest positions are. It does filter out companies that trade over $300 because that would be very expensive to purchase 100 shares. And then this is what you end up with. You have a primary position in Microsoft, followed by a secondary position. If you look over here in column I, you can see what your portfolio percentage is. The banks combined make the largest part of this portfolio at 30%. If we then go to Microsoft, that's our second biggest position. And then after that, it's much smaller with a 13% position in Apple, 5 in Facebook, 2 in Intel and Cisco, and 2 in Comcast. And so you look down here, you can see how many shares that ends up accumulating for a $150,000 model portfolio. So tomorrow we'll be doing the same strategy, except we'll be rolling over these positions, 8 covered calls. So now, whereas the S&P 500 strategy you could probably just do in your head, maybe you don't want to bother with the spreadsheet, you can see if you take it to the next level, now you really do need something to keep track of all these trades. And so it's still a very repetitive strategy, but now we have the luxury to aim our strike prices differently based on what the market's betting on each individual asset. So while we were bullish on much of the portfolio with the last trade alert, the option market clearly showed trouble with Apple in the short term. So we were bearish with that, and it actually paid off very well. So the option market told us exactly where to bet, or rather to take the bet by writing the covered call. And now we have the flexibility to get even better results by breaking it into these 8. Now, Thursday we have one last class, and this is our emerging markets class. This is taking the emerging markets ETF, same idea as the previous portfolio. This is our core position. The next biggest position is the metals combined, which is gold and silver, trading GDX and SLV. And you'll find that there's very high yields, particularly in the metals. But also, if we look at what's underneath the hood of the emerging markets ETF, you'll see that it does primarily invest in these 5 countries. So if we go to the actual country ETF, once again, we get a higher yield on the covered call. And so the big story over the weekend is that the PMI on China bumped up from below 50 to above 50, and everybody's going wild. Of course, China just injected some $1 trillion into their economy in January and February, and now we're all waiting to see what effect that has on potentially getting their growth story back in line. So this program is currently up 8.3%, and for those of you who do want to trade less and have potentially around 200K to trade with, we're currently recommending you put 75% into the American Corporation portfolio and then 25% into the emerging markets. And so this gives you some exposure to the metals, it gives you some exposure to the China story with the Made in China in 2025 and the China Belt initiative that they're pouring tons of money into. And it helps you take a little political risk out of the state side. For those of you who want to have the most liquidity and the most simplicity in their strategy, you really can't beat the SPY ETF. So for most of you, our basic level program is where it's at, and you can do it in your head, you can do it on the road, you can do it in 2 minutes. You know exactly when the trade alert comes out, every Monday, Wednesday, Friday, right at 11 Eastern. For those of you who'd prefer to trade once or twice a week and you do have more capital, this program makes more sense, but it's a little more advanced. Now we have to keep track of 8 different securities and 8 different options contracts we're writing. So it does get a little more advanced, and I wouldn't recommend doing this program in your head, whereas this one you might be well off. Now, one last note before we jump into some Q&A and then do some demos. In step 1, although you don't see it in this document because we can't automatically insert it, in your actual email is a link to your very own spreadsheet so that you can manage your trades, and that's highly recommended. So, all right, let's take a quick break and see who's got some questions out there. Mark is asking me if I think the gold and silver ETFs are manipulated, and if that is a problem. Let me pull up those charts particularly. But I'll tell you right off the bat, the answer to that is no, but let's take a look. And so yeah, if you're wondering if I think the gold and silver markets are manipulated, for sure. I mean, all markets are manipulated as much as they can, but there's always competition. So as soon as one medium-sized fish is taking advantage of a market, they enjoy it until a larger fish comes in and gobbles them right up. But we can talk about what the macro fundamentals are for having precious metals. And that's primarily that the central banks are acting very dovishly. The bond market is telling us they may lower rates right now, despite the stock market going up. And so there's good reason to have exposure to gold. Now, keep in mind the recommendation I'm allocating is relatively small. So first of all, if you had a $200,000 account, you would only have 50,000 in this portfolio, and of that, only about $8,900 total in the metals market. And Steve likes to do technical analysis. He's an advanced trader, and he's been following some of our programs for quite some time from various various publishers, and he's been saying that he thinks the SPY ETF is having a short-term pullback right now, and certainly at a very interesting level technically. We broke through this resistance line that's been giving the S&P 500 an awful lot of trouble. Our product's not very interested in technical analysis or trying to predict the future. We're really more interested in trying to write that covered call and see where the market's betting. And we're just going with the flow. So if the market's betting that the market will go down, we'll take that in the money covered call every time. And in general, we're going to be taking the smaller profits much more often than trying to be a young, avid investor going for growth. Okay, so let's see. We got a bunch of questions piling in. Let me see what we got here. Okay, Bill's concerned that he collected a $131 premium on Friday, but had to pay $339 to buy it back. Just want to make sure I'm doing this right. Thanks. Yeah, good question, Bill. And that's kind of what we started with talking about. So if the market goes up, you will never lose money in this program, period. So if you wake up and the news says S&P 500's up, you're doing well, okay? So that's the first thing to remember. Let's talk about the specifics of that. So you can see I have the same price to buy it back as you. And if we compare from Friday to today, the portfolio is up about $1,000. So how is that so? If we lost money on the covered call, how did we win? And that's because the underlying asset has gone from 278.89 and is currently trading, let's see where we're at right this second. It's currently trading at 285. So the change over the weekend is greater than the cost to buy it back. So we got what we were talking about $86 per contract. If you're assigned, if you're not assigned, you can just cover it and it's the same exact profit. So when the market's going up as rapidly as it is, you're going to feel like, oh gosh, I wish I was just holding the underlying asset and not writing the covered call. But that's just not the case for the stock market. It doesn't usually go up or down very rapidly. It usually bumbles around and does very little. And so that's when the true beauty of this strategy will really shine. So if we get a little pullback or some volatility in the next few months, everybody buying and holding will see all these profits they've enjoyed watching just kind of bounce around. But our program won't. We'll be collecting the same return over and over and over again. And that's around $50 to $100 credit 3 times a week. Sometimes we get a little higher. If we bet that the S&P 500 will go up and write the covered call above the trading price, we can now gain on the covered call and the underlying asset and push towards even higher profits. So let me take a look at one second. Let me pop that back open and I'll get all the okay. So this is the Dow Jones 100-year chart, and this is the nightmare situation for all you guys. Is if imagine we're right here in 1965. We've had this huge bull run from 1940 to 1964. Sure, there's volatility involved, but the general trend from this entire period is up, and everybody's become complacent. They think this will go on forever. No sign of inflation. People are talking about the same sort of things they're talking about right now, and all of a sudden the entire regime of rates changes. So from this whole period, we had a declining stock market that ran for truly, you didn't even, if you were investing heavily like we are, like our investors are right now, you had a 30-year window of no return. And so while we want to, capture as much of the upside as we can here, but we're much more concerned about a period like this. Our clientele are all 50 to 80, and they can't afford to make stupid mistakes and lose a lot of capital. So we're gonna look like the negative Nancy a lot when we're writing these strikes that are under the trading price. And that's because if we get rising rates for a long period of time, it's very negative for the stock market. It's not negative for our strategy. It will be negative for all the folks who are just buying and holding. So that is the primary fear of any investment strategy, really, is to be on the long side and the market is entering a new regime. So what's the best indicator for rising rates? Inflation's the best indicator. And so we can see we have very low prints in 2019. All the central banks are now saying that they want to overshoot inflation instead of just hit their target that they still can't hit. And so it's quite likely a scenario that could just be very well like this, where we have a outrageous bull market that finally pushes the rates up on the treasuries, and then finally the treasuries become enough competition to pull money away from the stock market. So we're cautiously optimistic right now in the stock market. And what's really neat about our product is because we're doing this covered call every Monday, Wednesday, Friday, really there's a million indicators out there trying to predict stock crashes, but the only one that really counts is when you see the market start to violently sell off. And when we do see that, that's when our product can really outperform most strategies. We can do it very easily. So let's talk about, well, first of all, any other questions out there? Oh, Mark wants to know if these results are based on, so you can earn $100, between $80 to $120 3 times a week for every 100 shares of the SPY ETF you own, Mark. So if you want to potentially bring in $10,000 to $15,000 a year of income, you would need 100 shares. If you want to double or triple that, you're going to need to double or triple the amount of underlying shares you own. Let's see what other questions we have. Then we'll start talking about what do we do in a nightmare situation. Let's say things get hairy, all this exuberance starts to reverse. You go back to the 08 crash, there was a recovery just like this, but it was just people buying because they're fearing they're going to miss out. And then once everything stalled a little bit, the crash continued. So let's see what other questions you guys got out there. And then we'll start talking about our 3 lines of defense. Really, we have 4 good ways to protect our portfolio that have higher and higher levels of risk to put into our portfolio. Any other questions out there before we jump into how we protect? Also, keep in mind, I'm going to need at least 1 guinea pig after we get through this portion of the webinar, where I'll unmute you and we'll talk out loud about what you're thinking about the programs, and I'll start to fill out your spreadsheet for you, and we can pretend you were entering a trade today. Okay, let's talk about downside protection. So it's very, very difficult to make money on the downside of the market, and that's because just most of the time it doesn't go down. And when it does go down, it goes very quickly and then changes direction. And it makes it very, very hard to be a bear. And that's just the way it's been for so long. So what's very interesting about the SPY ETF is that we can give ourselves free protection from the downside to a degree and generate retirement income without the risk of losing money. So the typical way most people would think about protecting against downside would be, number 1, just sell your shares and sit back and wait. You've had a huge 10-year bull market, and for many of you that makes sense. You might as well wait until the next crash. So that's the most obvious way, but now you're not going to be generating any income. And you're also doing this in a time period where every central bank is printing money and doing very loose monetary policy. So what's going to happen to the value of your nest egg if you let it just sit there? It's probably going to lose its buying power pretty quickly. So maybe that's not the best choice. So what's another idea? We could always buy VIX call options. Let's talk about that plan. This is probably one of the most overdone trades in history in the options market. There is a huge amount of capital that does nothing except wait for the VIX to spike, and then they short it with option spreads. And there's so much money doing this that it has become a self-reinforcing cycle that is leveraging and leveraging and leveraging this part of the market. And so it always happens. At some point, there will be a liquidation event, and those who are swimming with their pants off will be exposed. That's a famous Buffett quote. And you can see every few years there is a huge spike. Whether it lasts a day, a week, a month, a year, very hard to predict. So these VIX call options are one way to protect your portfolio, and we're getting near a pretty cheap price to do that. But the catch is, every day we're wrong, that call option quickly loses its value. So we're actually losing money in our retirement account when we put on a call option on the VIX. So while this is a great way to protect yourself, it only can go out about 6 months. And every day you're wrong, you're losing money. And to have enough capital in the VIX to protect your portfolio, you have to put a pretty sizable investment in. So in our portfolio, this is one way we do want to protect our assets, but not until we see the bleeding begin. So I'd rather jump into this as the trend is developing versus before the trend is developed. Okay, so that's one reason we are on hold to enter this hedge to protect our portfolio. And the VIX has been highly suppressed, so it'll probably continue to be suppressed until a big fish comes in and creates a major storm for us. The other strategy that's popular and makes a lot of sense is to buy leap option puts on a correlated asset that perhaps has more volatility. So the obvious one for the SPY is to short the QQQ with long put options. And so we can go 2 years out on the QQQ, but what if the QQQ goes up to 220 this year? Well, that put option is going to lose a ton of value. So once again, this is a scenario where I'd rather wait for a crash to develop and pay a higher premium than to be early. So what can we do in the short term to protect ourselves against volatility, still generate income so we're not getting buried in inflation and losing our buying power over time? And so that's where the covered call offers a brilliant way to protect yourself. And so if we thought for whatever reason something disastrous might come out between now and Wednesday, take a look at this strike right here. I can sell the 275 strike, so that means the S&P 500 would have to drop $10 from now and Wednesday, which is possible but very rare, extremely rare. What would happen if we wrote this covered call? So you can see it's trading at 285, and they would pay $10.12 to jump into that trade right now. And so, and actually that was the last trading price. The S&P 500 went up 30 cents. So you can see we could probably get filled right around 1036. And so what would happen if we were wrong? If we were wrong and the SPY jumped up between now and Wednesday, which is what the current momentum of the ETF is doing, what would happen? Well, we're going to miss out on the upside, and we're going to be assigned most likely. And so we're going to keep the 1036 that we were collecting by selling this option contract, and then we're going to sell our shares for a $10 loss. So you break even. So now you can have protection for free while owning the SPY. And if the SPY were to trade flat or between 285 and 275, we've generated that nice consistent profit that we want to do over and over and over again. So our first line of defense is a simple in the money covered call. We can protect most of the downside. We can adjust the strike every Monday, Wednesday, Friday, and we can still generate a return. So you can see how beautiful this strategy is when it comes to being able to protect your assets. Now you do this with any other ETF or any other security, and you're only going to have protection that is at a minimum a week out. So while we can adjust the strike price, Steve's asking if we do callers. No, this program is not for advanced trading. So we will never ever do anything like that. And I would argue it's very hard to generate a profit and protect yourself in the manner that you can do with a simple covered call. So are there more advanced strategies out there? Sure. But do we need it? Absolutely not. There's no reason to do that. And if you're not happy getting between a 30 and 50% annualized return just from doing a simple covered call and have downside protection, then you're probably a pro trader, and this is not the right product for you. But if you're the kind of guy who wants to trade for about 3 minutes, 11 Eastern, Monday, Wednesday, Friday, you might find that you get better results with this than anything else you're doing. Yeah, Steve, I agree. The sexiest part of this whole idea is the uniqueness of the SPY option contracts, having the Monday, Wednesday, Friday. And there's just no other product out there that does that. Now, maybe in a few years from now, the QQQ or the EEM ETF will open up those option markets, and that would even be more attractive perhaps. But in general, this is the only free way to be able to protect your assets through retirement and generate a consistent return. The intro, they settle at the close, I believe, but we're always covering and rolling over because I don't want to miss out on a second of option premium. So the rare case is that we get assigned overnight and then we'll just jump right back in the morning. But in general, yeah. And so a lot of people will ask, well, why are we going to buy it back for a penny when it's going to expire, in a few hours, and we keep all the profit? Well, that's because we don't want to miss out on the overnight premium we can collect. Okay, so I need a guinea pig for today, where I'll pull up your spreadsheet on the computer here, and I'll kind of interview you, and we'll see how you might fill out the box. Is there anybody who'd like to be our guinea pig for today? Just post in the chat box if you're open for it. Might have to be you again, Steve. Let's see who's going to raise their hand here. Oh, Mark wants to do it. All right, Mark. All right, I'm unmuting you, Mark.
What's going on, Jason?
Hey, Mark. How's it going, bud?
Pretty good. You?
Oh, doing great. Doing great. Today's one of those days where I wish I'd been a little more greedy with our trade alerts, but other than that, can't complain.
Don't complain.
Okay, let me pull up your spreadsheet here, Mark, and we'll. So you're thinking about doing the Tuesday, Thursday class with 150 and 50, right?
Absolutely.
Yep. All right. Well, that makes a lot of sense. Which email should I pull up for your
908. The 908, Mayor 908.
Okay. Give me a second, guys, and we'll pull up his sheet and we'll demo doing some trades. And if anyone has any other questions out there, please post away. So the Mayor Nick M908 at Gmail is the best one?
Yeah.
Okay. Make sure we get the fresh spreadsheet for that one. Let me send you a fresh updated template. I don't think you have this one, the newest template. So one really cool part about our product is our ability to create these. You haven't started filling out your spreadsheet yet, had you, Mark?
No.
Okay, I'm just going to issue a fresh one so you get the most updated template. So one of the biggest problems we found for investors is that they didn't know how to use spreadsheets to manage the trade alerts they're receiving and to really allocate the right amount of capital to each trade. And so that's one very nice free thing that everybody gets when they start their free trial, and you can keep it even if you never join our program, is you get a great spreadsheet with a very nice organization to manage your investments. And so that alone, I think you'll find will help boost your results, whether you end up following our trades or not. All right, give it another minute. So our factory creates spreadsheets that follow a template, issues you it via Google Drive, and then our team can pull it up and help you manage it. Now, if you do want to take it offline because you want to keep your information private, that's fine. You can always save it and run it from your local machine. Okay, we just issued a fresh sheet to Mark. Let me pull it up. All right, so here's the default settings that come in. And so I'm going to pull out the deposit in the, are you going to do the Monday, Wednesday, Friday also, Mark, or probably just one? the Tuesday, Thursday?
Tuesday, Thursday.
Okay. So I'm going to kill that deposit there. By default, we threw a 35K deposit in everybody's spreadsheet just so you know how to get going. And this is our basic level program. Again, it trades Monday, Wednesday, Friday. Let's go to the high yield. Okay, I'm going to go view full screen. Let me pull up my chat box. All right, now this one started off with a 150K deposit, so that's already in there. In the wrong year, but that doesn't matter. Okay, and the default settings on this one has 23% targeting income, steady income, which is Microsoft. This is the largest position in the S&P 500 and one of the least volatile stocks in the S&P 500. It has a low covered call yield that's very similar to the SPY and represents the biggest individual position in this portfolio. Now, do you want to keep that right there, or would you rather put more money into the higher yielding stocks below? Because if I go 0 here, you could put more capital into the higher yielders, but of course you're taking a little more risk on.
No, I think you're better off staying with the Microsoft at 23.
Yeah, keep it. Okay, great. So let's talk a little bit about how we chose this particular list of stocks and how much of each company to own. So this is really a reflection of the SPY ETF. And Bank of America, Wells Fargo, and Apple represent one of the SPY ETF's largest positions, which is Berkshire Hathaway. So again, we were able to remove the fluff, go directly to the security, and get a much higher yield. The Microsoft is the largest position in the S&P 500. So there you have your three largest positions, plus Apple makes 4. After that, we did look away from other potential companies and focused on the biggest tech positions. And so that's how this allocation was chosen. At the end of the day, you end up with around 300 shares of Microsoft, 100 of Apple, 100 of Facebook, 100 of Intel, 100 Cisco, 200 Comcast, 800 Bank of America, and then probably 400 in Wells Fargo to build what's very similar to the S&P 500. But now we can look at the option market and we can get an idea if the market thinks a certain security is going to have trouble in the next week. You'll see a lot of trading volume flowing into the put option market. So that's our no-brainer signal to play it safe that week. And last week we were bullish on all of the positions except for Apple, which actually paid off well. So let's go ahead and do the first set of trades. Now you might want to wait to do this in reality, Mark, till tomorrow, because we want to have the protection on at all times. There is protection on our portfolio at all times. And that is done, again, by the covered call. Now, I do see some questions popping up. Let me find my question box. It's hiding from me at this moment. Oh, there it is. Okay. Okay, Steve wants to demo how to close trades. Sure, yeah, absolutely. We'll do that in 1 second. Okay, so the first step for this would be, I'm just going to go like this. So if you hit Control Shift C, Control Shift C. Whoa. Okay, copy and then Control Shift V. That will paste text from one area of your spreadsheet to the other without the colors. Now, if I just paste it normally, you can see that does it. It does change the color scheme. That doesn't ruin anything, but for those of you who like to keep things looking nice. Control Shift V will save you some time. We don't want to purchase the exact amount issued here. We want to go to the closest multiple of 100. So I'm going to grab these prices, plop them right there. And now this part, I'm going to manually put the right amount. Now you can see up top, it's automatically understanding what we're buying and reflecting that into our trade alerts. So we can see our target percentage was 23% and we hit 23%. So it's just a colorful calculator. This is not high tech at this point. Now that doesn't mean we don't want to develop automation down the line, but for now, this allows everyone to keep track of what they should own, when they should own it, and organize their information in such a way that it's very clear what's going on. Now, if you're buying, it's positive in the shares. If it's selling, you would go negative. So watch what happens if I do this. You can see I'm right back to needing 400 shares of Wells Fargo. There's only one time we're going to sell our stocks. It's if we get a sign and we have no choice. And so what's nice is with this program, if we do a trade alert on a Tuesday, and let's say we're playing it really safe and we're totally wrong, the market flies up, we get assigned. You're going to be sitting in cash on that position until next Tuesday. So it's not some sort of program where we need to have a heart attack from now until the next trade alert. So there's no surprise trade alerts, there's no emergency trade alerts, there's no bonus trade alerts. There's just one simple trade, 11 Eastern. For this product, it's just Tuesdays. Okay, so we got this. If you want to fill in this part, this is most useful for your taxes, but it does not affect the software. You can keep track of your hold times and the P&L from buying and selling the underlying assets. So if you do want to keep track of that, you can do it right here. But you don't have to. So Tuesday is when we would actually put on the next set of covered calls. And so this is where we keep track of our open option writing. And as we close the positions, we pile them down here. One big benefit to this is if you believe that we live in a world where the big fish eventually eats all the small fish, there's potentially an argument that this is a more stable portfolio over the long haul than actually owning the S&P 500. And so certainly that has been the case as of recently. Another thing to think about is these tech companies are the most likely to disrupt other stable business models. So the S&P 500 has plenty of stable companies in it that have done well for a long time, and predicting that they would be disrupted is just not built into the options market. So that's why I really like this portfolio. It's also companies that, as a 34-year-old, I'm very familiar with and happy to follow the details as things progress. So it gives us 8 total companies to worry about, and these are really the dominant companies of the S&P 500. So there is that demo. Over here, if we were to see a serious crash develop, and only if we were to see a serious crash develop, this is when we would build our hedge. This is when we'd buy the VIX in the money call option with probably 9% of our total portfolio. And so again, it's going to be a in the money call option, so it won't need a huge spike in the VIX to generate some protection and profit for the portfolio. And then we go with the 1% 2-year leap option on the QQQ. But again, jumping into that is a losing proposition the day you enter it most of the time. So we're going to want to see the momentum really changing to the downside before we'll waste any money on that. In the meanwhile, we can protect ourselves very well simply from the covered call. Okay, so let's talk about how to roll these positions over. Let me go to today's trade. Well, all right, yeah, let's do this.
Jason, you don't take a position in the high yield bonds,
In the what?
the SJB? There's no position in there?
Okay, yeah. Oh, I forgot to talk about our fourth line of defense. Okay, in this particular portfolio, SJB is designed as a way for us to use a ETF to short the market in the high yield corporate bond market. So another reason this portfolio outperforms the S&P 500 is because of stock buybacks. If you look at the stock buyback index, it is outperforming the S&P 500. And guess who the biggest advocates of stock buybacks are? These particular companies. So yeah, if most likely before we do get some sort of epic stock crash, money has to become expensive for all these corporations who are taking on tons of debt and simply buying back their own stocks. And so SJB will be a great indicator if that is going up, that the stock market in general has some trouble ahead. So at some point we could allocate some resources to this ticker, but we're not going to do any covered calls on it. That would be simply to buy and hold in terms of a problem with the credit market. Does that make sense?
Yep.
Okay, so that's how we do that one. Oh yeah, emerging markets. Let me quickly show how to do the trades. One of the biggest advantages to this product relative to other strategies is going to be your willingness to put a lot of capital to work. If you've done any sort of risky option trading, you know that at any time you stand to potentially lose a great deal of your current trade. So most of the time, people who do that sort of trading, they end up betting small relative to their total account, so that when they do lose, it's not a blowout. And when they win, it's nice, but it's not going to be a huge impact on their total P&L. Our product's not like that. We want to put the majority of our capital to work and do a very good job protecting it and generate a very slow and steady income from the covered call. So I think you'll find that's very hard to outperform in the long run, especially if we enter a more difficult trading environment than one that just goes straight up, which a lot of people have enjoyed for the last 10 years. So first thing is you buy 100 shares of the SPY. Everybody knows how to do that. The next thing you do is sell to open the next expiration, and today's trade is on track to getting assigned again. This market is just hot. So we did this one. So let's look at this trade. It's trading at 285.46, but we're agreeing to sell our shares for a $1.46 loss right now. Why would we do that? Because we're going to get $2 right now. So if we're wrong with this defensive play, we make 50 bucks. And the guy who bought the call option, probably doubling his money. You know, he's doubling 50 into 100, or rather 200 into 400 maybe. Good for him. He might do that a few times a year, but most of the time he's going to lose most or all of his money. We're putting 100% of our capital to work, generating a tiny 20 basis point return, but we're doing it 3 times a week, 52 weeks a year, 156 times. And so when you do that, you're going to see this strategy is much smarter than trying to play the speculative growth side, especially with the mindset that we have to make this capital last for the rest of your life, and we cannot afford any screw-ups. So we sell to open 1 April 3rd, 2019, 284 call option. That's today's trade. If I were issuing this right now, I'd probably bump it up 50 cents if that was available. Okay, it only has $1. So you can see at this point in time, if we're assigned, we could make $50 max per contract, and then we're in cash. But what if it goes flat or slightly down? Well, now we can make up to $200 on the covered call, and that total P&L varies based on how much our underlying has changed. But we're not too worried about the underlying. because we're just going to keep doing this over and over and over again. So let's talk about covering it. So come Wednesday, what do? Buy to close. Okay, and then we'll be back into holding the asset, drop down to the next expiration, sell to open, adjust the strike. Let's say it was kept going up. Now we're going to do the 286. Okay, then Friday comes along, we buy to close, jump to the next expiration, sell to open. Next day comes, buy to close, drop the drop down. So this is the repetitive process we're doing. So Steve says these calls look like a 70% chance of getting assigned. So what I would say is yes, that's a 70% chance of us generating a profit. That's how you play the house. Okay, let's jump back to any questions on how to roll over a covered call? It's probably the easiest product most of you have ever seen in the options market, and that's by design. We can get a better return keeping things simple and not being greedy. And that's the main concept here. Okay, so same thing. How do you like the allocations on this one, Mark? Do you want to push a little more money into metals, be a little riskier on this one? You want to take a little bit of the assets out of the EEM ETF into some of these higher yielding individuals, or do you want to leave it as is?
I think we'll leave the portfolio as you wrote it.
Okay. So again, these are designed not to make any predictions. A lot of advisories you've most likely followed, you can't blame them. The gurus have pedigrees that are amazing. They've been doing this for decades. And the last thing they would want to do is try to track a benchmark for their return. Why would they do that? It makes no sense. They want to outperform. So that involves making predictions about the future. They have to predict what stock is going to outperform that isn't, or which sector is going to outperform that isn't. And so in doing so, you take a lot of risk. And so what happens over time is most people who try to beat the market end up underperforming the market. So we're not doing that. We're looking at where the market puts their money, and we're just siphoning off covered call income. So the longer we can get a stable asset that has a ton of money flowing it from all around the world, the better. Steve had to take off. Thanks for joining us, Steve. Okay, so let's talk about this portfolio. So we're going to make the least yield on the green one. That's what we call the steady income. If you wanted to follow this product with less capital, you could turn off the high yield section right here. Just go 0. Throw that 55 here, so we get to 63, 62. And so now we'd have all our capital in EEM. So if you didn't want to have to write 8 covered calls on Thursday's class, you could do that. Mark, what do you think? Would you rather do that, or would you rather do the full set of trades?
I think the full set is better.
Yeah, it is. It is. Okay, so let's leave it at the defaults. So I'm going to copy that, Control SV to keep the color coding nice. Now, the thing can get a little haywire. If you start typing in this right away, it doesn't know the price. And so I do like to put the price in first. And now we use a little common sense. We need 200, 200, 100, 100, 100, 100. And maybe if we have a little extra cash, we'll throw it in. The highest yielding product in all portfolios is silver, and that's because it's the riskiest, it has the most volatility, it has the easiest market to manipulate, so it inherently has the most risk. So you get rewarded for taking risk, of course. Now this represents in total $5,000 out of a $200,000 portfolio. So do I recommend going heavy on metals? No, certainly not. The allocation settings we have are well thought out and based on what the real world is allocating to these different assets. So again, these you'd wait till Thursday to actually do the price of the purchase and put in your exact price mark and then jump right into the covered calls so that you have the protection.
What time does those calls come out?
So yeah, we want everything to be so easy for you guys. Everything happens at 11 Eastern every day. So Monday, Wednesday, Friday for the basic program. Let me pull up the different products. So for our basic product, which retails at $9.97 a year, and our salespeople do have discounts if you call in. Not everybody wants to have to deal with them, so it's not a huge discount, but if you want a little discount, call in. We have two programs, Monday, Wednesday, Friday. Everyone can follow the TBT trade or the SPY trade. And some people are doing both of those combined, and that's easy to do. Just put a little allocation into here, pull a little bit out of here, and now you can see my model portfolio would be doing both. To keep things very simple, we've separated these two so that you just can follow one or the other if you like. So that's Monday, Wednesday, Friday, 11 Eastern. We take a 2-hour break and then we launch the Q&A webinar, and that's what you're on right now. This program is our diamond level program, trades on Tuesdays. And this is our gold level program, the emerging markets, and that trades on Thursdays. Again, every trade alert comes out at 11 Eastern. We will not touch the portfolio outside of that single trading point per day. And that again is to make the product easy to follow. Q&A webinars are optional. So if you have any questions or confusion, you can hop online and chat.
No, don't
And
you
Mark,
think
you're already a
the,
diamond member, so you're already set to jet.
yeah, don't you think that the emerging markets and the individual SPY gives you a better global diversification than just the SPY and the TBT?
Oh yeah, for sure. So certainly I like having, now some people have moral holdback. They don't want to support communist China. So certainly some people just choose not to support that product. But is there a good reason to be involved with emerging markets? Yes, I think that'll be the big story over the next decade. So as we see this portfolio finally maybe outperform in the next year or two, I might start saying, all right, it makes more sense to increase the weight on this part of your portfolio. Most people really seem to be pretty happy with the companies they know. And so they like the SPY ETF or the, these household brand names right here. Let's see, does anybody else want me to pull off their mute button so you can talk out loud? Kayleen asks if we can put a trailing stop on these stocks and ETFs. No, you cannot do that. Not with this strategy, and we don't want to. But we're trading this is the premium set of securities in the world. There's nothing better that you could invest your money in. So we're not worried about them crashing necessarily. And even if they do crash, they will crash at a slower rate than anything else out there, allowing our covered calls to do the job and protect our capital. So this is not some sort of fly-by-night day trading plan or something of that nature. This is a long-term buy and hold the security, but generate income from your covered call. A very serious long-term plan, not one of these, trailing stop, covered call, who knows what. Any other questions? All right, guys. Well, we had another great webinar and biggest turnout yet. Another trade alert coming out tomorrow morning, 11 Eastern, followed by a webinar 2 hours later at 1 Eastern. So thank you, everyone. And we really appreciate your time and look forward to the next webinar.